What is an index fund? An index fund invests in a basket of securities to achieve risk diversification. It tracks the performance of a specific index so as to seek return that is largely consistent with the market. If you are bullish on a certain asset class or market and yet unfamiliar with individual securities or companies, or are worried that the risks are too concentrated, then investing in an index fund is a relatively simple and low-cost way to diversify your investments. These funds track the performance of specific indices. Fund manager will invest in all or representative constituents of an index based on their respective weightings so as to seek returns that are largely consistent with the market. Investors who wish to capture the performance of the US market represented by the S&P 500 index only need to invest in a fund that tracks the benchmark, as opposed to having to buy all 500 individual stocks themselves. Same for bond investments. It would be hard for investors with limited capital to diversify their bond investments if they buy debt securities individually, which requires a rather substantial outlay. However, through investing in a bond index fund, investors only need to pay a relatively low entry fee for holding a basket of debt securities, which will enable them to achieve risk diversification and yield returns that are comparable to the broader bond market. What are the benefits of investing in an index fund? An invest fund allows investors to capture market opportunities and diversify risks with relatively low costs, and it is easy to handle. An index fund allows investors to invest in the markets that they desire based on their investment objectives. Although its goal is merely to track, as opposed to outperform, the market, it enables one to invest in a basket of securities and diversify risks with relatively low costs. It is also easy to handle, freeing investors from the onus of researching for or managing the portfolio.